FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
What is happening?
It's chilly. It's a cold morning here on the East Coast. 11 a.m. You see her in the middle. That's Elizabeth Thomas. She of SoFi. That's Dan Nathan. Hello, Dan.
Hi, guy.
I'm G Swizzle. By the way, if it's Wednesday, it's Butters, but today's Thursday, so we're going to jam him in because why not? Hello, everyone. Dan, how are you doing today?
I'm doing great. Liz Thomas just said something interesting to us, Guy. She said she's in Outlook. Heck, this is a family show. I think she used another word. And we were like, what do you mean Outlook? What's going on? Liz, what is the hell? Let's just say it. What is the hell that you're involved in right now?
Yeah, Outlook writing hell. Yeah, it's like at the end of the year, you end up in this deadline time, and I got to get a lot of words on paper. We got to make a lot of charts. There's a lot happening. The deadline is mostly self-imposed,
but fast approaching nonetheless.
But fast approaching, yes.
No,
yes.
you feel the pressure.
I'm working on it.
Feel like as with each passing day, you feel the urgency.
Well, you feel the pressure. I mean, it's not just like the deadline of getting the piece in. It's the pressure of being right? Which is we're always under that pressure. But outlooks just feel especially pressure cooker.
All right. So question: is there anything that could happen in the next few weeks? We have Fed meeting next week. There's probably I don't know. Maybe we get a Fed chair announced, right? Like, is there anything that might change your outlook? Any commentary from Fed Chair Powell, which is obviously, I don't mean this, I was going to say dead man walking. Is that a little too harsh? But, lame duck-ish, you know what I mean?
Yeah, he's not quite a lame duck until we know who the next chair is. But yes, we are waiting. So the self-imposed deadline is to have it done by Monday. And then we're going to wait for the Fed meeting in case we need to update anything. But honestly, some of this Japan stuff is changing pretty rapidly. So we're going to wait a little bit to see how that turns out in the next week or so, although we won't really know. So yes, there are a few things that might change. Unfortunately, we won't have labor data by the time we release it in time for compliance to approve. But yeah, I mean, but that's the problem is I could wait another month and say, well, I want to wait and see what happens here. And I want to wait and see what happens there. And then release an outlook some point in August of next year. Sometimes you just got to do it. But there's always a lot of nerves about it because you want to be right. You want to put a statement out there that's strong enough and have a stance, but you want to be right. You're worried about not being right. And I will say this, last year, I hemmed and hawed a lot. We put the piece out. I knew it was well done. We did a good job on the piece, but I was like, oh my gosh, but I'm really not sure if any of that's going to come true. And frankly, a lot of it did come true. So maybe being uncertain about it is a good sign.
Wow, I like that. See that? You just put it out there. And as we used to say at the Goldman Sachs, consistency is a moving target. So, you have to be able to sort of ebb and flow. And you tease something about Japan, but we'll wait for that because that's part of today's note, which, by the way, I love. Let's take a look at Bitcoin, Dan, because I do think a lot of what's been going on is sort of the ebbs and flows of Bitcoin. And we got down to a level, for whatever reason we held, and I think it was fiercely defended by the enthusiasts of Bitcoin. We had talked about months ago that if Bitcoin were to start to approach the levels of Strategies Holdings, which is now about 75,000, some strange things would happen. And over the last couple of weeks, people have been writing about that in earnest. So I look at it this way. I think it was defended in the short term. We're obviously bouncing off an oversold condition. I think maybe there's a little bit room left, but I don't think this story is over by any stretch to the downside, Dan.
Yeah, and I guess the reason why we're leading with it is just that it has been an interesting pocket of speculation of risk. And we could go back and say every few years that has been the case. This time around, though, it was coming off this sort of $2 trillion mark, which was bigger than the entire Russell 2000. You could have put it right in there with the Mag 7, that sort of thing. And, the volatility around it is interesting. But I think the leverage, I think that's the most important thing. And these treasury companies and the proliferation of them, then also the stable coins, and then some of the kind of regulation that we've seen around Genius Act. So there's a lot of things going on here. We just wanted to highlight that it's kind of had that little snap snap back. It got as low, I think, in a panic down to, let's say, 80,500. Now here we are at 92.5. You see the lines that we've drawn. They don't really mean anything. That 200-day, if you told me, it's going back there to 100, I'd say fine. I think a lot of the folks, I haven't seen any prominent bulls change their tune whatsoever. So for whatever that's worth. And Liz, I know that, a lot of your members, this is something that they've been very focused on. Is there any data or anything that you can take away from interest that you've seen, whether it be, I don't know, anecdotally, about where you think this might was that it in the near term? Are we headed back to 125?
I think that might be it in the near term. So a few things about this. We are, as SoFi, we are slowly rolling crypto back out and allowing our members to buy, sell, and hold crypto on our platform. It's not available to everybody yet. So we're getting there. So we don't have all of that data at this point. But a couple things that I would note about this. Crypto for a long time, or the better part of the last 2 years, has been very positively correlated to stocks, mostly the NASDAQ. So it was a risk on, risk off barometer. But this recent drawdown wasn't that, because over that same period where crypto saw this big drawdown, if you look from point to point, the NASDAQ was roughly flat. So there wasn't a commensurate drawdown in risk assets that made this make sense. So then you had to look at, all right, what is it being driven by? I think your leverage comment is a big one. I think liquidity, which is somewhat closely related to that, is another big one. So there's this liquidity concern that's been going on. And this is one of the things that we want to wait for the Fed to talk about, perhaps at the next meeting. But this liquidity concern in overnight funding markets and perhaps usage of what's called the standing repo facility, which is supposed to be an emergency measure, and it's starting to be used again. It's not really functioning the way that it should. The way that the Fed wants it to function is that nobody uses it, but it's being used again. So it is possible, and I'm not the first person to say this, but it is possible that the Fed is going to have to start expanding its balance sheet again if some of this liquidity stuff doesn't solve itself. And I think crypto reacted to those liquidity concerns as well.
Yeah, I agree with that. And if that were to happen, I think Bitcoin's going to love that. And,
yes,
you can overlay, you can overlay sort of the CME FedWatch tool with the recent movements in Bitcoin as well. It's amazing to me, and we'll get off of this in a second, but we traded down to as low as, I think, a 36% probability of a December rate cut next week now, as it turns out. And now I think it's north of 93% or something. So I don't really understand the volatility there, but I think Bitcoin's been trading around that. The other thing we have to go to, Liz, are the banks. And you look at this XLF, and it's been sideways for a period of time here. Now, if I'm being sincere, genuine, I've said this about other charts that, when you have this sort of period of time around the highs, the market doesn't give you that much time to sell the highs, which means we're probably going to take the next leg higher. Now, that flies in the face of what I think the bank should be doing, yet here we are. And I'll just say this quickly, if Amanda can throw up a Goldman Sachs chart, this stock has basically doubled. Think about that. It's gone up almost 100% since the April lows. And for the life of me, I don't know if we've seen anything like that before in some of these big name banks, Elizabeth.
Okay, so a few things. I just want to clarify. You think that the banks should not be acting well?
I don't. But that's
is that
me.
a cyclical? Yeah. Why not?
No, because if you look at, so I'll drill down a little bit. You look at delinquency rates, you look at the job numbers that have been coming out, look at some of the ISM numbers. I mean, everything sort of points to a slowdown. You couple that with the fact that I think the bond market is going to do things that the market is not prepared for. And then you throw that all in the mixer, and at some of the valuations these banks are trading at, a price to tangible book and price to book, it just doesn't make sense in this environment. That's just my take on things. Goldman Sachs is a bit of an outlier, but I'll throw them in the mix.
So you're putting banks in a cyclical column, which I think is the right thing to do. Banks are usually
absolutely they are, yeah.
Absolutely. So if we were looking at banks strictly on a cyclicality basis, they probably shouldn't be acting well. You're right. We've had some weakening in the economy. There hasn't been as much activity as we thought. If we look at it from maybe a markets and a regulation standpoint, so the yield curve in the US, the 10s, 2s, has been steepening, and I would expect more steepening as we go. And we'll talk about what Japan means for that in a little bit. But more steepening in the yield curve, perhaps there are investors saying, well, a steeper yield curve is good for banks, so that's supporting them. Not to mention, in 2026, there are a lot of moving pieces at the Fed, and this doesn't all have to do with the Fed. But what we don't talk about enough is that the Fed doesn't just vote on rates. They don't vote on just rate movements here and there, and they don't just do balance sheet stuff. They are also in charge of financial regulation. So the governors do vote on financial regulations. And if there are shakeups at the Fed in all of those seats in 2026, and if the administration perhaps gets what they want in some of those shakeups, you could see some changes in the stances on bank regulations in 26. So perhaps some of this is looking forward to that as well.
Yeah, and the other point I would just add is that, you saw the headline the other day that Anthropic, is looking to go public in 2026. It's a company that was valued in the private markets $183 billion. Think about that, $183 billion. So by the time it would go public, it would probably be valued at $360 billion. I mean, the valuations on some of these things are skipping around. And if Anthropic goes, then a lot of these other smaller ones would go, and who knows what it means for OpenAI. And the reason I bring this up, this would be an absolute field day for Goldman Sachs and Morgan Stanley, because they're going to be, tops on the list there. And then obviously there's a whole host of second tier banks. JP Morgan would be in there that would benefit from that. Just to, let's pull up the XLF again. We talk about it, poorly constructed, but it is a good proxy. We just had that chart up before. This morning on the open, I was looking at a way to fade this guy. I see what you see as far as this little rectangle that we built. I see the bounce off the 200-day. I was looking out to next Friday's expiration. Why? Well, we know that we have the Fed meeting, right? And you tell me, I don't know why these things are running the way they are, or the KRE, the regionals are doing this, that, whatever. But whatever happens, I could see basically the opposite of what happened this week possibly happening next week, right? And especially because what we just talked about. Okay, so fine. CME Fed funds, futures are suggesting near certainty of 25 basis point, but what sort of commentary goes? What does Fed Chair Powell want his legacy to be? And I know that's not for the December, there's 3 meetings, I think, after this that he'll participate in, but who knows? So to me, I was looking at the December 12th, next Friday expiration, 53.5 put when the ETF was trading about 53.5. That was trading at like 35 cents. So if you're buying the 53.5 put and it costs you 35 cents, you need a 53.15 break even to make money. I like the risk reward there. It's dollar cheap. I like the risk reward. So it's less than, you can do the math, again, less than 1% of the ETF, making a bet that it breaks even down 1%. I like those odds, so that's the way I'm kind of expressing myself here, Guy.
No, and I'm inclined to agree with you. The problem I have is just the resilience has been remarkable. The fact that we traded down and held the moving average. Now, albeit moving average is starting to flatten out here. I guess to your point, if you get some disappointing rhetoric out of the Fed next week, you could definitely see a back and fill here. But, I still sit around sort of scratching my head trying to understand why the enthusiasm of the banks over the last couple of weeks. Maybe it's just a season. Maybe it's just people playing catch up. Doug Cass just emailed us, I think. He has some thoughts on it. And a lot of these names are, through certain metrics, at historic highs, which I don't think makes a lot of sense in this environment. I mean, we're looking at price to book, price to tangible book for some of these names. JP Morgan specifically, that we haven't seen since either the global financial crisis or the great financial crisis, depending on what your G is, Dan.
I call it global, and Doug's saying JP, and this is something that you've highlighted too, at 3 times tangible book. I mean, like, there's a bubble, Liz, going on here. Let's talk about another thing, going back to, and this was kind of, Liz, a bell ringing moment. You remember November 2021, Mark Zuckerberg, he's all in on the metaverse, right? And he changed the freaking name of this company to Meta. Okay. And then this ended up being the sort of thing, if we want to go back, let's go back to, this is a static chart, as a guy likes to highlight. Let's go back to a 5-year, this stock went down. I know it looks like a blurb now, 70% from those 21 highs from the day the company changed its name. Now, Liz, it didn't start going up again until they started cutting jobs and cutting spend in Reality Labs, which is where Metaverse is. So the headline today, now let's go back to that static chart, is that they're going to cut in 2026, funding, whatever you want to call it, to Metaverse, to Meta Labs, to Reality Labs by 30%. Let's go back to that chart. So you see where the stock, it gapped up. it's no ability to quantify that. I'm not asking you to opine on the individual name, but when you see stocks starting to move higher based on the sorts of headlines we're getting, it's telling you that there's some things that are a little bit out of whack, Liz.
Well, yes, it's telling you that perhaps, but the other thing that happened, and this doesn't necessarily have to do with Meta, but the other thing that happened in November of 2021 was the word transitory was retired from the Fed's vocabulary. I think
Thankfully.
Powell said the good ship transitory was a crowded one. But anyway, they jumped off that boat. So this tells me something that's very important, and this is sort of reminiscent, or it resembles, we remember some of the layoffs that happened in a lot of tech companies in early 2022. There was bloat that needed to be cut, all of that occurred, although it never really showed up in the initial jobless claims number or the unemployment rate. But what this tells me is that investors are rewarding capital control, and perhaps that's a Meta specific theme. We don't know yet, but this is a situation where we're getting rewarded, or companies might get rewarded for controlling their spending, controlling their costs. And we'll see what happens in 2026. But I would imagine this also means that investors are looking for, again, where's the profit? Where's the revenue from all of this spending? And let's make sure that we're not just spending willy-nilly. So far, that's the biggest message that this sends to me.
We'll see. I mean, this is going to be fun to watch what happens at these moving averages, and if the 50 crosses the 200-day, and what happens if and when. I thought we were setting up for, excuse me, a bit of a relief rally, and today it appears as though people are getting into Facebook and out of Apple. We'll see how long that continues, but this is a bit of a battleground name. Real quick, before we go to Liz's note, let's take a look at Salesforce. We had talked about this for a while, that 230 level, which was the low we saw last June, traded down there a couple times. We thought it could hold. It looks like it may have. I still think there's a chance to trade to the 200-day, which is about 260 or thereabouts. I don't know if that's that inspiring to people, but for whatever reason, we've defended this level. Dan will point out correctly that if you look longer term, it just does not trade well. I agree with that. I don't think they're out of the woods by any stretch, but I think the quarter was good enough and guidance was good enough to sort of get a bit more of a bounce than we're seeing today, Dan.
Yeah, I mean, this reaction is actually pretty pathetic. I had an options trade short dated bullish into this, just thinking exactly what you're saying, Guy. You get a little bit of a pop, but up 2% is I got out of that pretty quickly on the opening, because this thing could be down on the day, in an hour or two. And if you're long, the idea that you get back towards, let's go to that 1 year chart for a second, back to that downtrend, that gets you to 260, 259. I mean, there's not a lot going on there. So, that's going to be where that 200-day is. And again, where they missed, these are not the places that you want to be missing on. And investors are not buying what Benioff is selling about agents in the SaaS business. So again, that is what it is. All right, Liz.
Oh, hold on. Can I set her up here?
Of course you can. I mean, it's your show, Guy.
No, it's not my show. It's our show.
It's our show.
It's a collective show.
It's your show, and it's my show, and it's Liz's show. Then it's
Elizabeth, I'm going to ask you a question that if you know the answer to, I wouldn't be surprised. But with that said, there's no reason for you to know the answer to this. Okay. Are you ready? Bill Emmett. Anything? Does that do anything for you? No, nor should it, by the way. So just sort of store that on one side of your brain. In 1926, Ernest Hemingway wrote, "The sun also rises," having nothing to do with Japan, by the way. It was about Paris running with the Bulls. I mean, a lot of things going on. I've actually read the book a couple times because I like Hemingway. In 1991, the aforementioned Bill Emmett wrote "The Sun Also Sets," and that was sort of a spin-off of that Hemingway book, but it was about Japan and sort of the impending, I don't want to say doom, but potential for a turn down. Your note speaks to potentially that. The sun also sets on Japan. See what I just did there?
Isn't it referred to as the land of the rising sun?
Well, yes.
Okay.
Yes.
Well, really quickly, can I get in here for 1 second?
Of course, your show.
Our show. Liz, are you too young to have seen this movie? It was a young Christian Bale, a much younger John Malkovich, a Steven Spielberg production, Empire of the Sun. This is absolutely amazing.
I don't know when it came out. I'm just too Liz to have seen that movie.
You're too Liz. Okay, that's for another show. That's for a whole different podcast.
Is that when the stormtroopers came in with the Wookiees?
No, guy,
that movie.
Guy, this was about I think British living in Hong Kong,
Ah,
interned by the Japanese. This
see.
movie. It's an amazing movie. Very
Interned, like locked up by, or interned like
locked
summer
up,
intern?
put in can, and it's based on a true. I'm pretty sure it's called Empire of the Sun. Doug will be all over that. All right, sorry. Back to you. Empire of the Sun, House of the Rising Sun, Land of the Sun.
Okay, so
Lots of suns.
this week's note, written by the wonderful Mario,
Love Mario.
is about Japan. Now, I'm going to take a minute here. I don't know how long this show is allowed to be today, but I'm going to
It's
take
your
my
show.
liberties because I think this is really important. So, everybody remembers back in July and August of 2024, there was a big hiccup in Japan. This was on the expectations that rates would rise. They had inflation that hadn't solved itself. There was a weak jobs report. There were economic things going on in Japan. We are in a structural shift, or whatever you want to call it, a regime change, an interest rate regime change in Japan. We are in the midst of it right now and watching it change things in the market. And I think many people would prefer that Japan just kept it to itself, but that's not what's likely to happen, and that already isn't what happened. So in July and August of 2024, there was a drawdown of 25% in the Nikkei, and the S&P fell 9%. This all happened very, very fast, if everybody remembers. Part of that was the carry trade unwind. So what's happening right now is similar, not exactly the same, but it's similar. There were headlines today, and there have been headlines all week about the Bank of Japan expected to raise rates at their next policy meeting, which is on December 19th. They would be raising rates. The expectation is raising rates from 0.5% up to 0.75%. That sounds very low, of course, but on a relative basis, Japan ran for about, I think, 7 years at negative 0.1% and then started raising rates. So on a relative basis, these are big numbers to Japan. So they're going to move from 0.5 to 0.75. As of now, that has about a 98% probability. And it looks like even the government isn't going to resist that move. They've got inflation at 2.7%, which again doesn't sound bad compared to us, but it hasn't really moved much since the last couple years. So they've got a little bit of an inflation problem. And there are some forces expected in their labor market to put pressure on wages upward as well. So inflation may get worse. Okay, so why do we care? I think most people are like, okay, I understand some stuff is happening in Japan. Why does it matter? This chart right here shows you how different Japan has been from the rest of the world. This is just policy rates of the Bank of Japan versus some other major policy rates. You can see everybody started raising rates in 2022 when inflation spiked. Japan's inflation didn't really spike. It got up to a high of 4.4%, and that wasn't until 2023. So they felt no need to do that. So they didn't. They started raising rates much, much later in 2024, hence the volatility that we saw. So this is kind of setting the stage. What this did was create basically what people thought of as free money in the carry trade, because Japan was so cheap, rates were so low, you could borrow money over there and go invest it in usually the US. That could be in treasuries, that could be in tech stocks, it could be in all sorts of things. And you were getting this free money. Well, now it's not free anymore. It's getting more expensive by the minute. So let's fast forward a little bit. Next chart. Why does this matter for markets? So Japan, this is just foreign holders of US Treasuries. So this does not include the United States holdings, which is by far the largest. But foreign holders, Japan is the largest foreign holder of US Treasuries. I think most people assume that it's China. It's actually Japan. Now, they only hold 1.2 trillion, which is still small in the grand scheme of things. But if rates are rising in Japan, and if the 10-year yield is rising in Japan, which it is, it's getting close to 2% right now, there's not as much incentive for Japanese investors to buy treasuries. Not only that, but as the debt that everybody took out before gets more expensive and they have to pay it back, they may have to dump the assets that they purchased with it in order to pay it back. So as this continues, if this continues, rates rising, the yen strengthening, which it has just a little bit in the last few weeks, and their assets falling, their equity assets falling, you could see, first of all, less demand for US Treasuries, if not outright selling of US Treasuries. So what this is likely to do to our markets is steepen the yield curve, or at least push the 10-year yield higher. Now, obviously that's bearish for the bond market, also bearish for equities that get discounted at that rate.
Well done. Extraordinary. I mean, you broke it down, you and Mario. Thank you for that. And more people are starting to come to the realization that this is important. And we're not just talking about it sort of, out there in left field. I mean, this has in my opinion, potentially very dire consequences for what's going on in the United States. And as Liz said, just go back to July of last year when dollar yen traded up to 161. It was on a Thursday. I think we came out with a CPI report here in the United States that was soft. I turned around, dollar yen went from 161 to 157, which you don't see in currencies. And that was the beginning of what crescendoed in early August of that year. If you recall the VIX, and if you recall what happened to our equity market. Are you seeing a replay of that? Yeah, in some ways, Liz said it's a little bit different this time. It is a little bit different this time, but the stars are lining up again, and they have issues over there. I mean, they're obviously going to try to defend their currency. They would hope that raising rates would do that. It really hasn't stemmed that tide. I mean, there are a lot of cross currents, but the most important thing for people watching here is if they are forced to sell assets, treasuries are the first thing that are going to go, and that puts pressure on our bond market, which makes yields go higher, which I think is bearish for the equity market, Dan.
Yeah, and you're talking about you're talking about the Japanese and the central bank, right? But there's also another they. It's those that are borrowing, as Liz just kind of laid out, cheap, right, over there, and they're buying expensive over here, right? And so we're seeing at a time like right now, the markets, trade pretty well. The S&P is up 16% of the year. The NASDAQ's up 22% of the year. But you are seeing some of those heavy lifter names, really come off their highs. We talked about Google and Apple, which are kind of bucking the trend. But the other ones, even with like a Meta bounce, is still down 10% from its recent high. So maybe some of that distribution is happening right now. Now, Guy, you said when we started this fine program that if it's Wednesday, it's Butters.
But it's on Wednesday.
Yeah, that's the one problem with this whole, sort of intro to what's going on here.
I think John got stuck in Michigan.
Okay.
Like he was on one of those islands. And there's a lot of like islands out there in the lakes, apparently. No.
Are there not? Are there though? Are there islands on lake? Is Madison? It's on one of the Great Lakes. No, isn't Madison on?
No, Madison's right in the middle of the state.
It's
right,
landlocked.
Oh, it is
landlocked.
I've been there. I don't know, for whatever reason I thought that. All right, it's Thursday. We're going to get a preview of John Butters' note. John is the senior earnings analyst over there at FactSet. He writes the Earnings Insight blog. You can have it in your inbox at factset.com/insight/subscribe, but we get a preview of it. And in light of what Liz is working on right now, which is her 2026 outlook, John's work is probably pretty helpful, Liz. So let's take a look at it. He's looking at the bottoms up EPS estimate for the S&P 500 for calendar year 2026. It is $309.18, a new record high EPS for the index. Over the past 25 years, analysts have overestimated the actual EPS number by 6.2%. Liz, are you going to overestimate the S&P 500 earnings expectation for 2026 by 6.2%?
I mean, I hope not. I don't put an earnings number out there, but this is a really interesting concept right now because we've gotten a decent number of outlooks, and many of those outlooks include price targets on the S&P, and everybody's kind of in the same range, like low double digits. So let's call it somewhere between 10 and 15% return on the S&P, which frankly is just an average return on the S&P for an annual return. If earnings growth ends up being a little bit stronger than the price return on the S&P, you don't have a multiple problem as much anymore because multiples wouldn't really expand and they might even contract a little bit. So there's been this growing sort of rumble about maybe the bubble doesn't end up being in prices only. The bubble actually ends up being in earnings expectations and the overestimation of earnings and the growth that we've all been relying on in earnings. Now, if earnings continue at this pace and if fundamentals stay strong as far as earnings and profit margins go, then we'll have another year where people will justify the multiple and say, well, there are fundamentals underlying this. Everything is still moving at a pretty good pace. It's durable, et cetera, et cetera. If 2026 turns out to be the year where we find out that earnings are actually inflated and expectations need to come down, I think the 6.2 number will look a lot bigger.
I look at this, Dan, and real quick, I'll say, okay, let's just play it out. Let's say as usual, there's an over expectation from analysts. So instead of 309, it comes in at, let's call it 300. And that would sort of track with what we've seen historically, right?
Mhm.
At that, at 6,900, which is where we are in the SP, you're still talking about a market that's trading close to 23 times. So maybe it's justified. Maybe it's different in the form of all the different companies and the growth rates, but you're still talking about a historically very rich S&P 500 potentially into a slowdown, and a slowdown maybe on the back of labor, Dan, which nobody seems to want to acknowledge for whatever reason.
Well, the data we've gotten a little bit on the labor front has not been particularly great, which is so like the fact that markets have been rallying off of weak labor market data and weak consumer data because it basically ensures that we're going to get this 25 basis point cut next week just makes absolutely no sense to me. And a lot of what you're talking about, Guy, though, and Liz has made this point again and again, it's been multiple expansion. I mean, like look at a Caterpillar is a great example. Caterpillar is trading at 32 times.
You love Caterpillar. I know it's so good.
32 times. It's making an all-time high. It looks like they cured cancer or at least came up with like the next GPU.
Okay. So this is what, and you're 100%. I'm laughing because it is sort of funny. But you look at this as again, you talk about cyclical companies. I mean, it's, Rust Belt America, and I say that in loving terms. I mean, this is something historically just sort of trades either side of the 200-day moving average. That's what you see historically, and that actually makes sense. Slow and steady wins the race. Since this summer, something obviously has happened, and it's this belief that this is one of these second derivative, third derivatives AI plays, and now we've completely divorced ourselves of any semblance of historical norms. And when you see a 200-day moving average of 412, and you see a stock trading north of $600, you say to yourself, something's got to give here. This is not going to last in perpetuity.
Right. 20% expected earnings growth after a year-over-year decline, and then 8% expected sales growth trading at 26, 27 times next year doesn't make sense to me. But this is really interesting, Liz, the last bit here. Analysts have overestimated the actual number in 17 years and underestimated the actual number in the other 8. Factoring in this average 6.2% overestimation, the index could report EPS of $290 for calendar year 2026. Which would still be a record, as John is saying here. But think about it. It doesn't do that much to the multiple if we are, $19 lower. It's still expensive relative to the 5 and 10 year results and averages over the.
Absolutely. It doesn't fix the valuation problem, but it maybe doesn't get it to euphoric levels. I think we've had most of this year with some of these pullbacks getting us back down to a more rational high place, but it's prevented us from getting to euphoria. So if 2026 shapes up to be a sort of meek year for returns, but earnings growth stays reasonably strong, then we have this same level of valuations by the end of next year. The other thing is, if we go from $309 down to $290 in earnings, that seems really dramatic, but that doesn't happen in one fell swoop. What would happen throughout the year is analyst expectations would slowly ratchet down, and they'd get closer and closer to the actual number. So it's not going to be like this dramatic, oh my gosh, it's $20 less in earnings per share. But, I think it's something that investors have to really heed the warning of. Maybe the inflation in prices isn't the main thing that we should be worried about. Maybe it is in earnings, and maybe all of these expectations for stronger revenue and higher productivity that's going to control costs are not going to come to fruition. Or in order to control costs, we have to cut other things like labor, and that obviously is not a positive outcome.
Yeah. And really quickly, I just want to button this conversation up and going back to your note also, Liz, and Doug Cass wrote this for thestreetpro.com this morning, and I should have kind of tied this in. So he was talking about with the Japanese bond market still weakening and providing a floor to U.S. interest rates, the equity risk premium has become an equity risk discount. This ERP status, virtually at the lowest level in 3 decades, is not a good launching point for future investment returns. This is kind of what you've been saying, and I know you've taken a look at the equity risk premium in the past. So maybe we just kind of want to button that up a little bit, Liz.
Yeah, I mean, the equity risk premium in the US has not been attractive for a long time because you're just not getting paid as much to take risk. But this is for investors putting money to use today. So at these levels, this is basically what this means. At these levels, you put money to work today, you're not getting paid to take that risk. And it has in a lot of places made more sense to buy bonds. Perhaps Japan is approaching that same level and it's going to make more sense, which again puts more pressure on our bond market, puts pressure on our equity market, puts pressure on the long end of the curve upward in yields. And not that this is something that I think could throw the world into recession, but it is something that is likely to have ripples around the globe as Japan works through this process.
Can we throw the John Butters slide up where you can find John's work, and then we will then go to where you can find Liz's work. Of course, factset.com/insight/subscribe. We've actually asked them to make it factset.com/butters. We'll see if that catches any.
Bill really dug that. So if you want it in your email box, don't go to factset.com/butters. Not yet. Not yet, but maybe in 2026. Now, Guy, all right. Thank you, John Butters. Thank you, FactSet. Amazing. So, Guy, I did short Liz as we were getting away from her fine note of where to find it.
Well, let's put that.
I think this is something that you would enjoy doing today, possibly.
Well, of course. I mean, by this point, hopefully you're all getting it, but there might be some new people that have joined us. So, to the extent that you're new, SoFi.com/on-the-money, which is a mouthful. However, in the new year, which will be 2026, it'll be SoFi.com/Liz, which is, Anthony Noto. Always see that West Point education coming. It's just really paying dividends. He understands the simplicity of that. Like, that's not confuse people.
Right. Yeah. He's definitely the one that did all the
engineering. Okay. So hold on. Before we get out of here, we're in December, as I mentioned earlier in the show. Liz and I talked about this, Dan, but you have been the NFL aficionado. There's a little bit of a quirk in the schedule. The Packers of Green Bay play the Bears of Chicago this Sunday at 4:25 p.m. Then the Packers travel to Denver, only then to go to Chicago to play the Bears again, Elizabeth. This is when December. It matters.
Yeah. Yeah. Well, we usually beat the Bears. So,
okay.
but this year, I mean, well, I'm not trying to be arrogant, but this year it's different. So it's going to be a tough December. I don't want to see the Bears twice in December. It's a holiday season.
Well, you're going to be happy during the holiday season. Doesn't matter what you want to see. That's what you're going to see.
Guy, there's something wrong with this line here. So the 9-3 Bears going to Lambeau, and I think it speaks to a little bit of what Liz is talking about.
The 8-3-1 Packers. That one is.
And they're favored by 6.5. Now
who are they?
Packers are.
Packers are. I would have
because it's at Lambeau. Because it's at Lambeau.
I know, but like let's just call these teams very evenly matched. You know what I mean? Let's just kind of just say that's table stakes. Wouldn't you have thought 2.5, 3 guy tops on that line? I mean,
I think, as Bill will tell you, I think if you're a home team, you get anywhere from 2.5 to 3 points for being the home team. So to your point, it should have been a pick'em game. Pick'em in so much as the Packers of Green Bay are favorite because they're home. That being said, I think what the betting community is saying is that the Bears, although they played good football this year, have they really been tested in the way that the Packers will test them at home at a 4:25 game, which the entire nation should theoretically be watching, which is why I think they're begging you to take the Bears in the points, which is why I think the Packers of Green Bay will cover.
Yeah, I mean, okay. So before January of this year, the Packers lost to the Bears. This is last season, obviously. The Packers lost to the Bears at Lambeau. That was the first time they lost to the Bears at Lambeau in 10 years. So that line I think that line should actually favor the Packers more.
Yeah.
So if the Bears are coming to Lambeau in a year when the Packers are doing just about as well, aside from that tie, I think the Pack looks good in this one.
But that tie looks a lot better now, being that the Cowboys of Dallas have been playing pretty decent football for the last month and a half or 2 months. So you can make the argument that the two best teams in the NFC might in fact be the aforementioned Cowboys and those Packers of Green Bay, Dan.
Yeah, so there's a couple things that stick out to me. Tonight's game, the Cowboys at the Lions, and the Lions are -3. I don't think the Cowboys are playing as good a football as you think they are, Guy. I think the Lions, this is like a must win for them. I mean that in the NFC North division. So I think they win by more than 3. It's another really weird line.
Okay.
And I know that. All right, here's another weird line. The Texans at the Chiefs. Okay, the Chiefs are playing horrible football.
Right.
Okay.
Texans are playing better.
Okay, KC minus 3.5 at home.
That's the home. They're getting the home team bump there.
Yeah, I
think
find that
the Chiefs. They've become the Mets to me. They can't lose
Mm.
enough. And tell the folks at home, Dan, in the beginning pre-season, there's a thing you're in where you can short a team and then get the subsequent value of that team credited to your account.
Yeah.
And I said you should short the Chiefs, and you're like, really? I said vraiment because I studied in French or France. And now look at them. They're a mediocre team.
Yeah, we did it too. By the way, though, the only problem is I took the Lions. I took the I took the Rams. I don't know, whatever.
The Rams. Listen.
I'm not doing great. Okay, Liz. One last thing before we get out of here. Your podcast, the important part.
Yeah.
The important point.
Uh-huh.
Important part.
The important part.
Hey, Liz.
Yes.
Your podcast, the important part.
Uh-huh.
It's going to be weekly next year. What are we doing?
Perhaps we're talking about it.
Okay.
Yeah.
And
It's,
so
it's bi-weekly right now, but yeah.
What do you got this? What's the latest here? Give us
The one that just released is a guy named Tim Higgins. He's a columnist at the Wall Street Journal. He writes about tech leaders, so Elon Musk, right? Tim Cook, all these people and companies, and how culture influences their decisions. And he walks through a lot of Tesla stuff, so it's an interesting one. But he was great. We talked about all the high stakes decisions that maybe former companies have made and how they've worked out. We talked about a recent article that he wrote about whether or not OpenAI was the next too big to fail. So it's a good one. Came out this week.
I will be tuning in. Now, I'm not the brightest bulb in the fixture, as you've come to know either over the last 41 minutes or prior to that watching Fast Money. But one of the many things that confuses me is like bi-weekly. Now, if you think about it, that could mean twice a week, but what it means is every 2 weeks. So it really can be confusing for me.
Well, because some people use biannual, but really biannual means every 2 years. It should be semi-annual if you're trying to say halfway through the year.
What's that word? It's a really fancy word for saying the second to last.
Oh, penultimate.
Bill had that before you.
What do you mean he had it before? I mean, what you asked me the question, I answered the freaking question.
Yeah, that was
there. There's no delay. I don't know what to even say to that.
In which you heard it, he answered it faster. That's a word.
He's sitting there. I'm sitting here.
If you use the word penultimate, you are doing the English language wrong. It's like you're saying 6 to 1, half a dozen to the other, or what's another one of these dumb phrases, Liz?
I disagree.
Yeah, I disagree too. I think you're using a word that's unique. Now, most people won't know what it means.
Somebody told me that his family was on the penultimate flight out of Iran before the the overthrow.
And you would have rather him say the second to last flight.
Well, I just said to him, I have no idea what that.
Nobody would know what it means.
I thought maybe that was bad. I thought maybe, you know what I mean? I don't know. Sure. You know what I mean? So and I said it to him. It's not like I just faked it. Like, oh, I knew what that is and went to the Google and did that. I was like, I have no idea. I've never.
Now you go to the perplexity.
Listen, I'm a simple man. I grew up not too different guy on the Hudson. You outside of Milwaukee, me, in Syracuse, New York. Fancy words like that. Guy, I know you got through your SATs on the math. Let's be clear, right there.
No, I think you'd be very surprised. I mean, I could effort my score, and I think you'd be shocked at my verbal skills. I'm a bit of a wordsmith. I've shown you. I don't know where my book is now, but I have.
Oh yeah, you do.
Those vocabulary books.
Liz, were you stronger on the verbal or the math on your SAT?
I had to take the ACT, not the SAT, but I was stronger on math, I believe. Out of all, there was math, science, language. I don't remember what it was called, language, perhaps. But yeah, math and language were high, but I think math was the highest.
There was not a lot on television last night, and I was tired, so I actually went to bed a little early. And at 10:15, The Wizard of Oz popped up. I'm like, oh yeah, bitches. Why do I mention that? Because Elizabeth played Dorothy in her middle school performance of The Wizard of Oz.
Don't we have a picture?
Yeah, we do.
We do. Yeah.
Maybe we'll share that one.
Go here, Liz.
Yeah.
This is like we do, but it's not.
We do.
I think somebody just said efforting. That's a guy.
I said efforting. I said
Effort.
efforting. That's not a word.
Guy uses that word.
Yeah,
I've
I will
never
effort that.
never used that word.
Well, it's not. It's
Me
really.
neither.
I'm not using it correctly, but there are people that say, "I will effort that." Like, can you get me the last 6 years performance of Caterpillar? I will effort that for you, Dan.
You say this on Fast Money you say our crack staff at EC.
I love saying that. Our
no one
crack
knows.
staff at
By the way,
EC.
no one knows. That's such a deep cut. Okay, and he'll say are efforting this.
Right.
That,
Our
right.
crack staff and EC are efforting that chart. Yeah, I do it all the time. Listen, I understand. Just so we're crystal effing clear, I understand that most of the time I'm speaking to an audience of about 3 people that I don't necessarily know, but I'm okay with that.
Yeah.
At least you know.
Liz,
I know.
Yeah.
Liz, do you
Okay.
want to leave us with anything? You're not in the studio with us. You often are.
No,
I miss
I know.
you.
I will come back. It's just that I gotta
so.
get this stuff done.
She'll
Yeah.
get shit done, man.
She's efforting guy to get her 2026 outlook.
Efforting my outlook.
And then she's going to Aqua at the end of the month.
But I think you should keep in mind John Butter's work, and you can even actually quote it if you want. The fact that over the last 25 years, strategists have overestimated
Analysts
have overestimated their S&P 500 earnings estimates by 6.2%.
Yeah, I think that's interesting. Yep.
Okay, so if you want to find that stat, you go to the Earnings Insight blog. You can have that in your email box.
FactSet.com/insight-/subscribe.
There's got to be equitable distribution. If you want Liz's on the money and you want that
almost. I saw a mock-up of /Liz yesterday.
/Liz.
That's fantastic. That's so clean.
Okay, guys, I gotta go.
Okay,
peace, Liz.
Bye, guys.
Thanks, guys. Bye-bye.